So we can start straight away. Uh, we were talking about financial markets, and I remember I stopped somewhere here last week, and I requested you to basically look at some of the definitions relating to these. I got different boxes here. So based on these, I requested you to look at some of the definitions. Were you able to do something? Any luck? Hmm? What has happened? Okay, given the interest of time, because we have now limited time, we have to finish our syllabus pretty soon. So I basically will go through the materials, slides again from this point onwards. Now, in the foreign exchange market, last week I think we defined or we tried to identify the forex market, and I mentioned to you there are various players playing in the forex market, especially the dealers and the brokers, where we have interbank trading as well as customer trading. And then we looked at the definition of the exchange rate and different ways of expressing the exchange rate, the direct quotes, indirect quotes, the effective rates, nominal effective rates, real effective rates. I think we had some kind of a discussion last week. And today I basically plan to move from that point onwards. So when you look at the foreign exchange market, we have to consider the prevailing exchange rate regime in that foreign exchange market. Exchange rate regime means that is basically decided by the authorities. Could be the government, could be the central bank. The foreign exchange market is basically behaving or having its features based on the regime that is in place. Now, these regimes, as I said, decided by the government, and there are various types of regimes in the foreign exchange rate regimes, and we can basically broadly classify them into two. First one, the fixed or pegged exchange rate system. So in a pegged exchange rate system, now in this case you don't have any notes given, so probably you may take your own notes very briefly. I'm not going to spend too much time on this. You can basically have some uh, key understanding. So the fixed or pegged exchange rate regime is a kind of a price control system. Why you call it a price control system? The government or the central bank is fixing the exchange rate at a particular level, and that is being announced to the market. For example, the government say, okay, the dollar rupee exchange rate is 110 rupees per dollar. So that is decided by the government or the central bank, and that is announced to the market. All market transactions are happening at that rate. All market transactions are happening at that rate because the rate is fixed. So the market cannot do any other transactions, I mean, above or below these rates. So this should be the rate. And the authorities, they may refix this rate time to time. They have the authority to do so. Now in Sri Lanka, we had this system before 1977 when our economy economy was liberalized. Before the economy was liberalized in Sri Lanka, time to time we had this fixed or pegged exchange rate regime, which means the government, the central bank, has decided the exchange rate. Now, at the time of the liberalization of the economy in 1978, the dollar has been fixed at around 8.72 rupees per dollar. Rupee has been fixed, the exchange rate. So even before that, time to time, there were periods that the government has announced a particular exchange rate. This type of exchange rate regime is having pluses as well as minuses. The plus is the exchange rate does not change substantially, does not become volatile. So the market participants can do their transactions with some certainty. But the problem is this type of exchange rate cannot be maintained for a long time, because to keep the exchange rate at that particular level, the central bank has to have an intervention in the foreign exchange market, which means it has to supply foreign exchange, buy foreign exchange, to keep the rate at this point. Because if you have a price fix, there could be excess demand, excess supply happening in the market for dollars. So that shortage has to be filled. Otherwise, if you don't fill the shortage in the market, there could be another exchange rate. So the central bank has a role to play there by putting dollars or absorbing dollars to keep that rate. You can do it when you have a good, high number of reserves. When you have foreign resources, you can do that, foreign assets. But in Sri Lanka, what has happened, we don't have that much of reserves, so we had to abandon the system by 1977, when the economy was moving to open economic policies. And also with this fixed exchange rate, black market rates, which means a different price in the market would happen. That is also a possibility. Second regime is floating or flexible exchange rate regimes. Now, by definition, floating or flexible means it is changing because of the demand supply conditions in the economy. So this exchange rate regime is a free market based exchange rate system. So based on the demand for foreign exchange coming from the people who needs foreign currency, and based on the supply of foreign currency, which means who basically bring foreign currency to the country, like exporters, tourists, etc. So the rate is determined based on the interaction between demand and supply, uh, without any intervention of the authority. So the authority will not say the rate should be this much, this level. Instead, the market will determine the exchange rate. So as a result, you might observe exchange rate variations compared to a fixed system. So every day the rate is changing. Wallet could be volatile because of the fact that the exchange rate is determined in the uh, free market. But even though we call it a free market, sometimes there could be the central bank intervention in this market. There are some periods the exchange rate is becoming heavily pressurized on either way, either to appreciate or depreciate. So in that case, there should be some mechanism to support the exchange rate where the central bank is injecting dollars or absorbing dollars in the foreign exchange market. When the market is having a pressure for for a depreciation of the exchange rate, the central bank injects dollars. When there is an excess in the market and the exchange rate is going to appreciate, the central bank buys extra dollars from the market. So likewise, the central bank buy and sell foreign exchange in the market, and that is having implications on domestic currency as well, which means the rupee level would also change, because when you buy foreign exchange, you have to inject rupees. When you sell foreign exchange, you have to absorb rupees. Likewise, it has an impact on the rupee levels as well. So this method is used by many countries because it is considered as a market-based mechanism. Rather than artificially controlling the exchange rate, you are allowing exchange rate to be determined based on the economic forces, economic principles. But as I said, this becomes, or this leads to exchange rate to be very volatile. So ups and downs could be there due to this methodology, this regime. In Sri Lanka, starting from 2001, we have this system. We have this floating exchange rate regime in place. Give me a minute. Sorry. We have this floating exchange rate regime since 2001. So the central bank has allowed market to determine the exchange rate based on the demand supply conditions of the market. At the same time, the central bank is intervening in the foreign exchange market when there is a pressure. That happens. Even now, it happens. So right now, if you look at the exchange rate in Sri Lanka, is highly pressurized because of low foreign currency inflows coming from this COVID-19 pandemic situation. But the central bank is trying hard to keep the exchange rate at, at least at a reasonable level. But it all depends on the central bank's ability to buy and sell dollars based on its reserves. So its reserves are also a limited resource. You don't have excess reserves, excess money, foreign currency. So that is a kind of a concern that we have. Now I told you up to 1977 we had, hello, yeah, up to 1977 we had the fixed exchange rate regime. Then I said from 2001 onwards we have the floating exchange rate regime in Sri Lanka. What we had during 1997, 1978 to 2001, in between, what is the mechanism we had? Is anyone having any idea?
trans is transformed as an open economic.
Open, sorry, but I didn't get your point. We moved to open economy, that's true. Okay. What is the exchange rate we had? I mean, the regime we had in between. We have a specific name for that. Any idea?
Yes, sir.
Yes? Have you typed any answer? Let me check the chat box because I can't see it from there. Yeah, someone has said, okay, there are different types of exchange rate regimes, broadly in line with what I have said. I'm just asking what we had in during the period of 1978 to 2001 in Sri Lanka. So in Sri Lanka, during that period, we had a system called managed floating exchange rate. So in between, in Sri Lanka, we had a managed float. So managed float by name, you can understand it's floating. The rate is not fixed, but it's been managed. So central bank has been managed this float. How it has managed? On a daily basis, the central bank announced its buying and selling rates for foreign currency. Buying and selling rates for foreign currency, because the central bank didn't want to allow exchange rate to be 100% determined in the market. So that's one end. The other end, the central bank didn't want to fully control the exchange rate. So it has allowed some flexibility. So as a result, the central bank, what has happened? The bank announced buying and selling rates. It's a kind of a range, buying price and the selling price to the market on a daily basis. So market transactions happen during this or within this buying and selling range, or they have taken that as an indicator, guidance to do the transactions. So this system is called as a managed floating system, where the central bank has a large intervention in the market by way of deciding the range. Why the central bank is deciding a range? To prevent the volatility. Okay? To prevent the volatility in the rates. Okay? So I think with that you have some idea about this part. And then the other box, changes in the exchange rate. Now exchange rates are not static. They are changing on a, I mean, even in a minute's time, it's changing. Not years or months, but even within few seconds, the exchange rate is changing. From one level to the other level, it's changing. So when the exchange rate is changing, we need to measure that change. We need to identify the direction of that change. How do we identify? We look at the appreciation and the depreciation of the exchange rate. So appreciation means the increase in the value of the domestic currency in terms of foreign currency. Increase in the value of the domestic currency in terms of foreign currency. For example, let's say LKR is 198 today for USD. Yesterday, right? This was the LKR amount that we pay to buy a dollar. Now today, let's say it has gone down to 195 per dollar. So this suggests the LKR has appreciated, which means the value of the domestic currency has gone up. You are paying less to buy a foreign currency. Okay? Depreciation is the other way around. The value of the domestic currency diminishes or decreases in terms of foreign currency. You have to pay more to buy a foreign currency. Let's say from 198, it goes up to 200 rupees per dollar. So to buy $1 compared to yesterday, you have to pay more. So which means depreciation. So appreciation and depreciation is we are normally talking under this floating exchange rate regime, because in a fixed system you cannot have appreciation or depreciation automatically. Why? the rate is fixed. But in a flexible system, floating system, given the forces of demand and supply for foreign currency, it could be appreciation of exchange rate or there could be a depreciation of the exchange rate. Okay. Now, if you want, you can calculate the rate of change. Rate of change in the sense rate of appreciation or depreciation. Now, let's say we have an example, dollar sterling exchange rate. Okay. Now let's say initially to buy a sterling you have to pay $1.25. Okay. And then thereafter you have to pay $1.35 to buy a sterling. So you would see the amount you pay to buy a sterling in terms of dollars has changed. So the exchange rate has changed. I don't know whether it's an appreciation or depreciation. I'm just saying has changed. So my question here, what is the direction of the exchange rate, whether it is an appreciation or a depreciation? Second, the rate of appreciation or depreciation. How do you answer this question? So first, let me know whether it's an appreciation or a depreciation. Let's say dollar is the domestic currency, sterling is the foreign currency. Earlier you paid 1.25, now you pay 1.35. Dollar appreciated or depreciated? Dollar is appreciated.
It's depreciation, sir.
Depreciated, yes. Dollar is depreciated. You are paying more, isn't it? You are paying more. Okay. Now, the rate of depreciation, how do you calculate? To do that, we have a very simple formula. E1 minus E0 divided by E0 multiplied by 100. This is the simple formula to calculate the exchange rate, depreciation and appreciation. E1 means the current exchange rate, E0 means the previous exchange rate divided by previous exchange rate into 100. So can you calculate the rate of depreciation for this matter? What is the rate of depreciation based on this? If you have a calculator, you can quickly do that. Have you done it? I would prefer if you can give me the answer because I can't see the chat box.
Is it 8%, sir?
8%. Yes. So how do you calculate it? Simply current exchange rate is 1.35 minus The previous exchange rate is 1.25 divided by 1.25. So every day or every month you will see the central bank says, okay, exchange rate has appreciated or depreciated this much. So that is calculated based on this simple formula. Okay. You might need these things when not only in the exam, in your working environment, that would be really important. Okay. So that is appreciation and depreciation. We are done with that. Then let's look at some types of foreign exchange transactions. In the market, there are various foreign exchange transactions. We have different names given for these transactions. These are done by the market participants. Market participants means basically banks. In Sri Lanka, market participants in the foreign exchange market means banks. In some countries, it could be maybe other entities like non-banks, clearing houses. There are various entities. In Sri Lanka, in the foreign exchange market, the players are the banks. We call them as market participants, and they do various type of transactions, namely spot, term, cash, forward. Those are the key types of transactions. What do you mean by spot transaction? We need to know these terms.
Delivery of purchases or sales of the foreign currency within 2 business days.
Exactly. Spot means, even though the name spot means, I mean, it indicates instantaneously, right now. But it's not the case. In terms of spot transactions, as you correctly said, it's a trade of foreign currency, and the delivery of the transaction will be in 2 business days or 2 working days. Delivery means what? Basically, the settlement of the transaction. Delivery means the settlement. You do the transaction today, and that will be settled in a separate day. So for a spot transaction, it's done on T+2 basis. T+2 means 2 working days from the date of transaction. Why these 2 working days are given? I mean, what's the purpose of having this future delivery date? The idea is, when you enter into transactions, you have to follow some formalities. You have to do some paperwork. In today's world, paperwork is less, but you need to have some formalities. And in finance, there is a word called due diligence. Due diligence. So it indicates to check, examine whether the transaction is genuine, authentic. Likewise, whether the funds are, coming from a genuine source. Likewise, you need to do some scrutiny about your transaction. That's basically due diligence. For that matter, you allow some time. That's why you have T+2. This rate done on T+2 basis, the spot transaction is the transaction. The rate you call it as the spot rate. So when you see S in the foreign exchange market, let's say ST, that indicates the spot exchange rate dealers are using for the transactions. Then you have Tom and cash. Tom means actually tomorrow. So in a Tom transaction, the delivery will happen in the next working day, T+1. Tom means T+1. Transaction is settled on the next working day. Cash is a transaction of deliveries for the same day, T plus 0. So in the market, you have all these type of transactions, T plus, T0. T0 is done for urgent transactions. You need money today. You can agree for a T plus 0. Spot transactions are the most common transactions in the market. Okay, and then forward rate, forward transactions. Forward transactions are basically, now in a forward contract, you agree to deliver on a future date at the agreed exchange rate today. So in a forward transaction, you have actually T plus could be a 7-day, 1 month, 3 month, likewise. So what you are essentially doing here, you agree today to settle the transaction in 1 month's time, 7 days time, 3 months time. So it's a future date. So in a forward transaction, the delivery will happen in the future at the forward exchange rate, and that forward rate is agreed today. So these are actually used in the market as a kind of a derivative. Derivative in the sense you are trying to minimize the risk of change in the exchange rates in the future. If you enter to the transaction today and keeping the future exchange rate in mind, you are basically trying to minimize any variation in the exchange rate. So these forward rates are basically deriving some profits or losses. We will look at in the next few slides. Okay. So forward rate, I think here I have given you a definition also. The rate that you agree today to do the transaction in the future, and that will lead to a kind of a forward premium or a forward discount. In the next slides, I have some more elaboration on this. So when you look at the foreign exchange forward transactions, I already mentioned it's a contract to deliver currency at a future date. So you will settle the transaction at the future date, but at the exchange rate agreed today. You are doing the transaction in the future, but you agree today. Let's say you enter into a foreign exchange transaction to buy dollars 200 rupees in the future, in 3 months time, and you enter to that agreement today. You are saying, okay, I'm buying dollars at 200 on the 3 months time date. In 3 months time, it could be 198 or 202. The exchange rate could be different. But you have already agreed that you will buy at 200. So you have to buy at that price. So if you agree at 200 today and at that rate, at that date, the exchange rate is 998, what you will do? You will make a loss, because on that particular date, the spot rate is less than your forward rate. Similarly, on that date, if the exchange rate is 202 in the market, the spot rate, you are making a profit on that date. Why? You are basically buying at 200. So it's a kind of a profit for you. So this mechanism is used to mitigate the changes in the exchange rate in future. As we already know, the rates are changing. It's not static. So you are entering into a transaction to mitigate the risk, to control the loss that you might incur. You call it exchange rate risk. We remember under market risk we discuss various risks: asset price risk, inflation risk, interest rate risk. Likewise, the exchange rate is an important risk. So through a forward contract, you can mitigate the exchange rate risk. Now, in these forward exchange transactions, the rate determined is the forward exchange rate. So in finance, you see the term F, or letter F, sometimes FT plus 1, simply, or simply F. It indicates the forward exchange rate. So that forward exchange rate is used in a forward contract, and this is actually, sometimes you call it forward rate, forward price, various names are there. This is calculated using the interest rates of the two currencies. Let's say you have LKR and dollar. So the LKR dollar F forward rate is calculated based on the interest rate for LKR, interest rate for USD. Because every currency has an interest rate, isn't it? Rupee has an interest rate, dollar has an interest rate. So you take interest rate differential, so the difference between the interest rates of two currencies to calculate the forward rate. Theoretically, you call it covered interest rate parity, which we are not going to discuss here because it's some theory not related to our discussion. What I really want to tell you, the forward rate is calculated using the interest rates differentials of the currencies. I have an example in the next slide. I'll show you how these interest rates are coming to place. So you call it covered interest parity. Now, one important thing of this forward rate, why it is important, in financial markets, we consider this forward rate as a kind of a predictor. You call it unbiased predictor of the future spot rate. What does that mean? Let's say your forward rate, you are calculating the forward rate for 3 months, next 3 months. Now you are doing this today, isn't it? You are doing this today. So you calculate, you enter into transaction forward rate in 3 months. So actually on the, after the 3 months time, on that day, there is a spot rate, right? In 3 months time, there is a spot rate. Spot rate means the prevailing exchange rate on that day. So when you calculate forward rate today, you don't know this spot rate in the future, isn't it? We don't know. But when you calculate this forward rate for 3 months using interest rate parity or interest rate differentials, this F3, the forward rate, is giving some idea about this future spot rate. So that is an important advantage of these forward rates. It gives some idea about the future spot rate when the market is reasonably efficient. Okay. Here I have presented you kind of a calculation of the forward rate. Now so far in your exam, we haven't seen the calculations of forward rates. There are calculations, but not the rates, some premiums. So these forward rates are not given as an exercise in your exam up to now, but that doesn't guarantee you might not have this. There could be a situation you have to calculate the forward rate. So how do you calculate this forward rate? Very simply, as we already know, sorry, F is the forward rate. So when you calculate F, you use S. S means the spot rate. So spot rate multiplied by this part. So in this part, 1 plus RD means the domestic interest rate. 1 plus RF means the foreign interest rate. Imagine that you are calculating the forward rate for US dollar. Now let's say this information is given. US dollar today 195 LKR. Rupee interest rate, let's say RD is 5%. Foreign interest rate, USD interest rate, which means RF, 2%. So when you have all this information, the current spot rate, domestic interest rate, foreign interest rate, you can calculate this F, forward rate, using the interest rate. So the interest rate differential means if you look at this RD and RF, there is a 3% differential. So based on that, you are getting a forward rate. I think I have a example given here, which we are not going to calculate in practice, but we have, let's say, the spot Canadian dollar USD rate is given as 1.1239. So here, this is the spot rate. 3-month interest rates are given for Canadian dollar and US dollar, 0.75 and 0.4. So you have to take 1 plus 0.75, which means RD, if you assume Canadian dollar as the domestic currency. Now, if you look at this part, there's another operation. What is this part? 90 divided by 360. Why is that? You have to convert these annual figures into 3 months figures. Look at our question, 3 months interest rate. So in order to get the 3 months rate, you have to multiply by it 0.25, or you have to divide this by 4. Then you have 1 plus 0.4. This is basically RF, USD interest rate. Again, you have to treat for time conversion. And when you solve this part, what you get is 1.1249, which is the forward rate. This is the spot rate. Now, can someone tell me, by looking at this spot rate and the forward rate, what is your observation? Let's forget about the calculation part, this part. What is your observation between the forward and the spot rate?
So it makes profit for today's transaction.
Sorry?
It makes profit for today's transaction.
Yes, how it happens? Now, spot rate is 1.29 today, 1.1239 today. Forward rate is 1.1249 in the future.
Because
now in 3 months time, now this forward rate is calculated 1.1249. In 3 months time, it could be 1.2, let's say 41. So this is the future spot trade, not this one, right? So in 3 months time, this could be the spot trade. So based on this spot trade, in 3 months time, what you can have? You can have a profit or a loss. Because on that particular date, let's say you have a contract. In the contract, you have rate as 1.1249. But actual exchange rate on that day, 1.1241. So what's happening? You are making a loss, right? You are paying more. That can happen in the future. It could be other way around also. Your spot rate could be higher than the forward rate. That's a different story. So in the future, you may make a profit or a loss. What I'm asking, compared to today's spot rate and future exchange rate, what do you observe? Today's spot rate is 1.239. Your calculated future rate is 1.1249. Higher or lower?
It's higher.
It's higher. It's higher. So when it is higher or lower, we use a specific term. What do you call it? A premium or a discount. So the difference between the forward rate F and the spot rate S, we call them as swap points, right? In finance literature, you call it swap points. So if these swap points are generating a positive value, you call it a forward premium. If these swap points are generating a negative value, you call it a forward discount. Now let's say in this case, what do you have? Forward premium or a discount?
It's premium, sir.
It's premium. Why? Your future exchange rate is higher than your current spot rate. So this part, the calculation of forward premiums and discounts can be seen in your exam paper. Your forward exchange rate discussion is limited to that, calculating forward premiums or a discount. So it's a simple calculation. I think we have some questions in the paper. For example, let's take one question, otherwise won't be having some clear understanding. So let's do one of the calculations from the exam paper. So I'm just trying to pick a question. Okay, this is the question. It's from September 2018. Okay, no, let's take another recent one. Right, I'm taking March 2019 paper. I think I have that in the slides. Let me check. Yeah, here. March 2019 paper, because I picked up that question because I don't have answers given to you. Other questions I have given you the answers. Right, here, if the spot rate, the USD LKR rate is 179, so that is S. And 1 month forward exchange rate, USD LKR rate, that is F, equals 190, 80. what is the annualized 1 month premium? Now, how do you calculate this? To do this, whether it's a premium or a discount, how do you calculate it? You have a very simple formula to do that. You need to take the difference between the future rate and the spot rate as a percent of, or as a share of spot rate, and multiplied by the time factor. So here the time factor is annualized 1 month forward premium. So if you are multiplying by the time factor, you have to divide this or multiply by 12 divided 1. So this is the simple formula that you can adapt to calculate this. So would you be able to calculate and tell me whether we have a premium or a discount in this case, and the amount of that premium or a discount? Just take a moment. By simply looking at the numbers, you can say there is a premium or a discount by simply looking at the numbers. Spot is 179, forward is 180. Is it a premium or a discount?
It's a premium.
It's a premium. So we need to calculate the value of that premium. That's why you use this formula. What could be the value?
Is 0.0670 something.
I think there's another part to be done. You have to multiply this by 100 because you give it as a percentage. Sorry, I missed that part. So if you do multiplication by 100, what do you get?
It's 6%.
6.7. It should be 6.7%. So based on this currency, if you are entering into a contract today, a forward contract, you are having a premium of 6.7 on your currency based on today's numbers. So as I said in your exam paper, the most of the questions so far related to this premium. So if you look at some of the questions, now this is 2018 September question. Again, it's a 3-month forward premium question. Answers are given here. Then if you look at this question in 2017 September, no, not this one, this one, 2016 question, you have forward premium to be calculated. So likewise, either you have to calculate the cross exchange rate or mostly the premium is your task in the exams. Okay. I think in your handout, I have given you the answers and some of the calculations I have actually elaborated. So please have a look into that. Okay. Now, are we okay with the foreign exchange market? Do you have any questions to be raised? We can go further, but I'm just limiting to our discussion. I mean, considering the scope of our paper. Yeah, I'm not going to that much of details. Any question?
So when it comes to forward exchange rate, how do we get that interest rate, sir? Because why not?
Yes, now in this case, that's a good question. In this case, as I said in your exam paper, you are not given any task to calculate that forward rate. Now in the question I gave you just now, I gave you forward rate 180, right? That 180 is given to you. You don't need to calculate. If you need to calculate that 180, you need the interest rates. Remember, the domestic rate and the foreign rate. Look at this part here. I'll remove this doodling. Now in this case, if you want to calculate this F, this is F, then you need these interest rates, foreign and the domestic rates. But in your exam, actually this part is not considered. You are straight away given the spot rate and the forward rate. So you don't have to worry about this part. So I assume you will not have that tough time in the exam calculating the forward rate. But you should know the mechanism behind that. That's why I said there's no guarantee you will not have this in the exam. If you know it, then you will be able to do it. Okay.
Okay, sir. Thank you.
Let's move to other markets. Now, other than these markets that we have already discussed, there are some markets relating to financial markets. On the surface, you might think, what is the relationship with the financial market? For example, commodity markets. Commodity market means it's a market for primary goods rather than manufactured goods. A commodity means a kind of a primary good. There are various types of commodities. Soft commodities, hard commodities. Now, soft commodities you can name as agricultural products: wheat, coffee, cocoa, sugar, and even coconut oil. Recently, you can add as a kind of a soft commodity. Hard commodities are, some uh, materials that use in production process like gold, rubber, petroleum. So those are hard commodities. So there are about 50 major commodity markets in the world. Now, why this commodity market is important for the financial sector? These commodity markets are having link with the financial markets through the futures markets, which we call as derivatives market. Now, people enter into transactions in these commodity markets to exchange these commodities in the future based on the derivatives. For example, for oil, you can have a derivative contract today. Now, let's say today oil is $60 per barrel. You agree with an investor, okay, you will buy oil in 1 year's time at $62 per barrel. So this is future oil price. You agree today. In the future, this could be 65 or 70 or whatever, but you do the transaction at this price. So this is referred to as derivatives in the commodity market. So I have given you another explanation, a kind of a classification for commodities market. You have precious metals, base metals, energy, agriculture. So this is some additional information. But the relevance of the commodity market to the financial market is the commodities are used to generate financial transactions in terms of derivatives. Then we have informal finance. Now what we have already discussed up to now is formal financial market. Then we also have informal financial markets. Now in the informal financial markets, there are savings and credit facilities provided for small farmers in the rural area, low income people in the villages, the small scale enterprises even in the urban areas. So this is some informal way of giving finance. Now what are the best examples for these informal markets? In the informal financial market, this is not banking, not non-banking, not a formal method. There's no regulator, but that is also supporting the financial system in a way. Any example for these financial markets, informal markets? Any idea? Any bright ideas?
So it's something like government enterprise that helps to small enterprises.
But when you say government, that's basically through what? Basically through some formal channel, isn't it? When you have the government. But here, you don't have any link with the government or any formal channel. I think if I give you an example, you would understand. Now, in the village areas, you have these informal money lenders, isn't it? What do you call them in Sinhala? Poli Mudalali. And cheat to system, right? In village areas, you have this cheat to. All these are some informal way of financing. In the urban areas, in these markets, Paliagoda fish market, in the money market, there are informal money lenders on day basis. Now, this is not a part of the formal system, but still they are providing some service in the financial sector. The problem is if it is growing large, growing bigger, then it's an issue. So the role of the regulators and the government is to bring them back into the formal system, which means attract those people into the formal banking and non-banking system. But it's providing some service. So in the informal financial markets, we know you can take credit very simply. You can ask money very simply, a loan from a person. So transaction costs are very low. But the funding cost, the interest is really high. Now, for example, in the money market, if you take a day loan, interest could be 100%. You borrow something, you give double as a return. And in village areas, as I said, these informal money lenders, they are charging very exorbitantly high interest rates. Could be 10% per month. So annually it becomes 120%. But the good thing is the repayments are really high. You have to repay very quickly, and if you don't repay, you will lose some of your assets or even your confidence, reputation. Many things could happen. So we don't encourage this market, but it's there. Informal financial system. So I have given you the advantages and disadvantages. This box. So this market is unregulated, which means there's no overseen by the central bank or whoever. We have to formulate policies to bring them to the formal system. And then let's look at some international financial markets. Financial markets are Now, what we have discussed so far is the local domestic financial market. But international financial markets, you can divide them into two: bond markets and the equity markets. So, international financial markets, international bond market, international equity market. So, in the international bond market, there are three types of bonds traded. One is foreign bonds. So, these foreign bonds are traditional instruments in the international bond market. They are sold and denominated in foreign currency. Let's say dollar bond, sterling bonds, yen bonds. Likewise, they are denominated in the respective foreign currency. Okay, so these are traditional. There's a recent innovation for these foreign bonds. You call them as euro bonds. Euro bonds. Sometimes you call them as, I think probably you may have heard this term, sovereign bonds. Sovereign bonds means basically bonds issued by the government. So it's a bond denominated in a currency this should be other than of the currency in which it is sold. Now let's say Sri Lanka is selling a euro bond. Now ideally, if Sri Lanka is selling a bond, it should be rupees, isn't it? But this bond is not in rupees. It could be in dollars, it could be in sterlings. It's an international currency. So in Sri Lanka, we have issued these bonds. In Sri Lanka means by Sri Lanka, Sri Lankan government has issued these bonds, international sovereign bonds. Probably you may have heard the term ISBs, international sovereign bonds. So these are issued in foreign countries, in Singapore, in London markets, but it belongs to us. We have issued, as the Sri Lankan government, we have issued these things in the international markets for foreigners. You call them as euro bonds. Then traditionally there is another type of kind of a bond. It's actually not a bond. You can call it a deposit. This is actually a deposit. Euro currency deposits. Euro currency means foreign currencies deposited in banks outside the home country. Now let's say American people, they deposit US dollar in European banks. You call it euro dollar. Japanese people, they keep their money in other markets, other banks, foreign banks. You may call it euro yen. So this is your own currency, sorry, own people's money deposited in banks outside the home country. Out of these different type of bonds, I would say that second one is very important, because as I said, it's a recent innovation and a lot of countries are using these international sovereign bonds. Then international stock markets. We know stock markets are a very important source of financing. Internationally, there are large, very active stock markets operating in the world. Now, if you look at global stock markets, In these global stock markets, MNCs are raising capital. MNCs means multinational corporations. Multinational corporations. For example, Nestle could be, I don't know, General Motors, could be Toyota. These are MNCs, multinational companies. They are raising capital in the international stock markets, equity markets. So until recently, the US stock market was the largest market. Now, a lot of Asian markets have seen growing importance. Now, if you look at the chart top, these are 10 largest global IPOs in 2009. IPOs means initial public offerings, which means issuing stocks for the first time. Now, if you look at issuance of stocks for the first time, the first place is taken by Hong Kong, which is an Asian country. And also, if you look at most of these places of this top 10, Shanghai, Shanghai Star, Shenzhen, all these are Chinese stock markets, which means Asian markets have grown substantially. Hong Kong, China, even Singapore, the largest stock market, even India, Bombay Stock Exchange, they have grown as very important stock markets in the world. So when you look at the international stock markets, you need to look at some international barometers, indicators of the health of the stock market. For that matter, we use price indices. I think the most famous price index in the world is the S&P 500 price index. It's in the US stock market, S&P. So the movements of the S&P index is giving an indication about the global stock markets. And there are some other known indices like Tokyo Nikkei, Dow Jones in US. So these are some important indicators. Now, if you look at financial markets in Sri Lanka, there's a long history for financial, kind of a fairly long history for the capital markets in Sri Lanka. But the modern or the recent developments in the markets can be tracked for last 30-40 years, especially starting from 1980s. We have seen financial market has been evolving in Sri Lanka, especially the stock market. And if you look at our financial market, there are various sub-markets, as I have given in this picture: money markets, foreign exchange market, the Garmin securities market, private debt market, equity market. Likewise, various sub-markets are there. And these markets are at different levels, which means some markets are fairly developed, some markets are at early stages, some markets are very active, some markets are not that active, some markets require some reforms. So likewise, some different features are there for these markets operating in the Sri Lankan context. Now let's look at these markets one by one. Any questions you have up to now?
No, sir.
How about others? All okay? Right, then let's move. Yes. Now, in the financial market, if you go back to this diagram, we have this money market. It's a very important market. Money market means the domestic rupee market. So the domestic rupee market can be divided into two major markets. One is the coal market. The other one is the repo market. Now, if you look at this table, sorry, it's divided into coal money and repo market. By numbers, you would see the coal market is the most important market by the size. Repo market is also important. Coal market is basically an overnight money market to fulfill the needs of the banking sector. Coal money market is the market for borrowing and lending of the needs, for the needs of the banking sector. So on a daily basis, banks are either borrow or lend in this coal market. The importance of the coal market is these funds are without collateral. You don't need to have any collateral to borrow funds in the coal market. You, in the sense, banks. They just pick up the phone and ask for these funds. That's why you call it coal market. So it's a very active, dynamic market. No defaults. Banks are very trustworthy, confident in this market. So to fulfill their daily funding needs, they borrow and lend in the coal market. For the central bank, coal market is very important. Why? The central bank is conducting monetary policy. Remember, its monetary policy operations to inject liquidity or absorb liquidity is done through this to impact the coal market. So if the coal market is in shortage, the central bank injects money. The coal market is in deficit, in excess, the central bank absorbs money. So central bank's monetary policies adjustments are reflected in this coal market. And if you recall our monetary policy discussion, I introduced a very important interest rate to you, AWCMR. That is average weighted coal money rate. So this is the average rate in the coal market of transactions, interest rate. So hopefully you remember this is the operating target of the central bank, coal money rate. Other than the coal money market, as I said, there is a small market called repo market. Sorry, here. So in the repo market, what happens? Banks and primary dealers, not only the banks and primary dealers, they borrow and lend in the money market. So here in the repo market, I think the term repo, you have some idea. To do repo, you have to give and take. What you give may be money, you are taking a security. Or other way around, you are giving a security, getting money. So in the repo market, banks and primary dealers are fulfilling their fund needs using securities, government securities. Right? So that is basically the money market. In this table, you have information on the central bank operations also. That is also part of the money market. But when we say the money market, broadly what we talk is the coal money and the repo market. The foreign exchange market in Sri Lanka, I think it's an important market because that fulfills the needs of the foreign exchange transactions. So in this market, currencies are traded between banks. I told you banks are the only players. So in the interbank foreign exchange market, banks are buying and selling foreign exchange, and that determines the direction of the exchange rate. Direction of the exchange rate means whether the exchange rate is appreciating or depreciating is determined through the movements of the or transactions in the foreign exchange market. So if there's a large inflow of foreign exchange on a particular day, there could be an appreciation pressure. If there's a large outflow of funds, which means people are demanding more funds, it could lead to a depreciation of the exchange rate. So that is basically determining the exchange rate in a free floating way, as we already discussed. And the central bank is intervening to smooth out any volatility. To keep the stability in the exchange market, the central bank is basically intervening. One thing, important thing I need to mention here, the foreign exchange market is sensitive, obviously, to foreign exchange inflows and outflows, and that is reflected in banks' balance sheets. So you call it this net open positions. So if the bank's balance sheet indicates their foreign currency liabilities are higher than their assets, you call it a negative net open position. So that will have a pressure on the exchange rate. If on aggregate basis, banks are having more assets, foreign currency assets than the liabilities, then that indicates positive net open position. So on such dates, the exchange rate is having less pressure to depreciate. Okay? So all in all, the bank's foreign currency position is an important factor in the foreign exchange market. So in this market, as I have already said, currencies are converted and the foreign currency, the foreign transactions are supported. For example, funding the imports. If you want to convert your export proceeds, you can use the foreign exchange market. Nowadays, there's a requirement. Foreign exporters should bring their foreign exchange back to the country. So when they are converting their foreign exchange, the market is helping. The government treasury bill, treasury bond investments, which means foreign investments, they are also supported through the foreign exchange market in Sri Lanka. Then we have the government securities market, one of the major markets in Sri Lanka. In this market, the government securities are traded, which means treasury bills, treasury bonds, Sri Lanka development bonds, etc. These are government instruments that they use for public debt purposes. So the primary market and the secondary market are important in terms of the government securities market. The government's funding need is collected in the primary market. So primary market is happening only through the central bank, between the central bank and the primary dealers. Let's say the government needs 50 billion rupees this week. So when the government needs that money, the central bank is conducting an auction with the primary dealers. So through that auction, central bank is selling treasury bills or bonds to the primary dealers, 50 billion worth of securities. So you call it primary market. Secondary market means the primary dealers, what they have bought, they can sell to the public in the secondary market. And let's say if someone is having already securities, so he can trade such securities in the secondary market. So secondary market is offering or providing liquidity to the instruments, which means you can trade, you can do transactions in the secondary market. Now in Sri Lanka, treasury bonds are the main instrument in the government securities market. And in Sri Lanka, we also have dollar denominated government securities, which we called as Sri Lanka development bonds. And in the previous slide, I told you Sri Lanka has issued Euro bonds. You call them as ISBs, international sovereign bonds. But these are not traded in Sri Lankan markets. They are traded in international markets. Garmin securities market is open for foreigners in Sri Lanka. Foreign companies, foreigners, Sri Lankan expats, they can come and buy Garmin securities, treasury bills, and treasury bonds. Earlier it was 10%, up to 10% level. Sorry, now it's 5%. So out of the total stock of treasury bills and treasury bonds, they can buy up to 5%. Why this is introduced? To attract foreign money, foreign currency, for the purpose of popularizing the securities, as well as to earn attract foreign money. So here some more information on the Garmin securities market. As I said, in the Garmin securities market we have treasury bills and treasury bonds market. Treasury bill market, in the primary auction you can see these interest rates. You call them as yield rates. I'll be discussing these yield rates in a separate session in a detailed manner. So these are indicating some movements of the interest rates. Yield curve, I think we discussed under interest rate, if you remember. So yield curve is basically representing the direction of interest rates based on the market expectation. So in the second chart we have yield curve. So yield curve is basically at a particular point you can draw a yield curve. At end 2017, yield curve is the yellow line. At end 2019, the blue line is the yield curve. So it is drawn at a particular point, then that indicates the movements of interest rate structure in the economy. So in the Sri Lankan Garmin securities market, these are very important instruments that we are looking at. Then the corporate debt market in Sri Lanka. Corporate debt market means private bond market. So in Sri Lanka, the private bond market is very thin in the sense it's at a developing stage, very small market. It's an alternative funding method for the private companies. Now, usually private companies raise funds through the stock market. But in the debt market, they can use bonds similar to the government securities market where you trade bonds. In the corporate debt market, you can use bonds to raise money. So main instruments are the commercial papers and corporate debentures. I think you may have heard the term debentures. So if you look at this chart in Sri Lanka, debentures are the most popular corporate debt instrument. And the private entities are using these debentures to raise funds. But as I said, it's a very small market in Sri Lanka. Now I have some outdated information 2015. But the point is, if you look at this corporate debt market size in Sri Lanka, it's only 2% of GDP. I'm sure even now, if you take this, it's not more than 3% or 4%. So it's very small market in Sri Lanka, corporate debt. Equity market, it's a final and important market in Sri Lanka. In Sri Lanka, an equity market, I think closer to 300 companies are operating in the Colombo Stock Exchange, representing 20 business sectors. So in Sri Lankan stock market, we have 20 major sectors operating in Sri Lanka. Now, what is the main stock exchange in Sri Lanka? The Colombo Stock Exchange. Colombo Stock Exchange, located in Colombo, and it also has some branches. In some places, Kandy, Anuradhapura. Likewise, there are few regional stock exchanges helping to investors to come and buy sell stocks in Sri Lanka, right? Now, in the stock market in Sri Lanka, it's regulated by the Securities and Exchange Commission, not by the central bank. It's a separate regulator. And at the CSC, Colombo Stock Exchange, there are two main systems operating: central depository system. I think you might remember we were talking about depositories, right? So the central depository is the depository for stocks transactions. Yeah, you keep records, do ownership transfer and all that. It's happening there. And then there's an automated trading system in Colombo Stock Exchange where the transactions are happening automatically. Bids and offers for stocks buying and selling are automatically settled. So by 2020 June, the stock market was at very slow level. But if you look at January numbers in Sri Lanka, the stock market has reached a good level of around 3,000, roughly 3,700 plus million mark. I think you may have observed in recent times the Sri Lankan stock market has been performing well, whatever the reasons, compared to last year. And I have presented you some numbers here related to companies. If you look at some few companies are basically dominating, or they are the largest companies in Sri Lanka. So if you look at these numbers, the Ceylon Tobacco, the John Keel's Dialog, these companies are the major companies in Sri Lanka. If you add up the first 10 companies in Sri Lanka, I think it's more than 30% stake in the total market. So they are very significant. Now, related to the stock market, we need to look at some important indicators. These indicators are in your exam paper as well. Some related questions are there for these indicators. So one important indicator showing the health of the performance of the stock market is the share price index. Price index or share price index, they are very important to understand the performance of the stock market. So in Sri Lanka, we have two major stock indices, share price indices. First one is All Share Price Index, ASPI. ASPI, it represents the whole market. So it is calculated as a market capitalization weighted index. So every company is given a weight based on their market capitalization. For example, in this table, CTC is given 7.95, John Key is given 7.6. Likewise, every company is given a certain weight, and based on that weight and their shares listed in the stock market, the share price on a particular date, you can calculate this ASPI. So the importance of the ASPI is it shows the overall trend in the market, overall, not only few companies or markets. So if you have 300 companies, 300 companies' performance is reflected in the All Share Price Index. So it's a good indicator to get some understanding about the market behavior. Then in Sri Lanka, we have an index called S&P Sri Lanka 2020. S&P Sri Lanka 2020 index. So that covers, by name, it covers 20 companies. They are the largest and most liquid companies in the Sri Lankan stock market. They are the largest. Largest means by size, capitalization by size. They are the largest. Not only large, they should have most liquid stocks. Liquid means should be traded frequently. So if they are traded frequently and if they are large in the company size, you can put them together and calculate an index to see the most influential companies in the stock market. That is the purpose. So you can plot these two, ASPI and SPI, see whether they are moving in the same direction. So if they are moving in the same direction, that indicates S&P, the major companies are performing like ASPI. If they are going in different directions, that indicates not the S&P, the key company is doing well. Maybe some other company is doing well, right? So this is an important indicator to see the movements of the stock markets. And as I already mentioned, in Sri Lanka, there are 20 indices, 20 subsectors. For each and every subsector, you have an index. For example, I have listed these sectors in this table. So you have 20 sectors here: banking, finance, beverage, construction, chemical, diversified, footwear, hotels, healthcare, investment. Likewise, there are various subsectors operating in the Sri Lankan stock market, and each subsector is having a index. Why it is important? Now, as an investor, you would like to see which sectors are doing well. Maybe ASPI is good, but maybe some other sectoral indices are not good. For example, these days, if you look at the hotel sector, it's not doing well. Maybe these days, the motor sector, it's not doing well. During these days, maybe telecommunications are doing well. Maybe the banking sector is doing well. Likewise, you can have ideas about different companies and different sectors. Investors need that. Remember the diversification idea. You cannot put everything into one sector. You can choose different sectors based on the different movements of their particular sector. So sectoral indices are really important. And then there are some important indicators calculated in the stock market. These indicators are basically followed by investors. For them, these indicators are important to take investment decisions. What are these indicators? The first one is the TRI. TRI, Total Return Index. So on a daily basis, total return index is calculated other than the price indexes. What does that mean? The total return index is capturing both price changes and dividend income. So total return equals, if you take the total return of a stock, there are two elements. First, price change, the price between current price and the previous price. You call it the capital appreciation or depreciation, plus dividend income. So dividend income is very important. Why? The stocks are giving you dividends, kind of a cash benefit. So if you take both together, you can calculate a total return index. So this is the best measure of the returns. Returns means what you earn from an investor perspective. So if you are an investor, you would look at not only your price change, you would see how the dividends are paid by these companies, because dividends are the cash income for the investors. So they are worried or they are interested about dividends. So the total return index is giving some idea about the return received by an investor in terms of price change as well as the cash dividends. And then we have PE ratio. PE ratio means price earning ratio. So these ratios are important when you value a company. If you are an investor, when you buy shares, you look at some valuation of the company. You need to look at whether this company is doing well, company is going to perform well or whatever. You have to have some idea. So investors, they do some valuations of the company. So one such measure to value companies is the price earning ratio. How do you calculate it? You use market value per share. What is the market value per that particular share? And earnings of that particular share. So you divide market value by the earnings per share. So then that gives you some ratio determining whether your shares are correctly valued in relation to the other. So if the shares are properly valued, the P ratio should give you an indication of that. Then you have dividend yield. Dividend yield, I think there is a mistake. You have to remove this part, dividend yield. So dividend yield is calculated as the dividends as a share of the current share price. So you can write this as dividend divided by share price. So that indicates how much the company pays dividends, because there are some companies, they are not paying dividends regularly. So investors, as I said, they are looking for dividends, cash income. So in order to get some understanding, the measure that they can use is the dividend yield. How much they pay in terms of cash dividends against the share price. So these, as I remember, in some of your exam papers, you have to write some, simple definitions and why it is important. So be mindful of that. You might have to give some, very simple answers, but you need to know it. If you know it, then only you will be able to answer. Otherwise, you will be having no marks. So I think with that, we are done with the markets. And after that, I have given you a whole lot of exam questions. And for calculations, I have given you the answers also and way to calculate. So I really recommend you look at these exam questions very carefully. And I have already added 2021, the recent paper also, for your benefit. Okay. Now, for example, we just discussed Garmin securities instruments used by the Sri Lankan government. Now, if you look at the first question, you can answer that easily from this discussion. List 2 foreign currency debt instruments. I already mentioned SLDB, Sri Lanka Development Bonds. And I told you sovereign bonds, international sovereign bonds, ISBs. Then name one of the index used in the domestic stock market and major foreign stock markets. I just mentioned to you domestic stock market, you have ASPI, remember? I also mentioned to S&P 500, S&P Sri Lanka 20. In global markets, I mentioned to S&P 500, Dow Jones Index, Nikkei Index. You can have some more index. So actually this question you cannot answer up to now because we have to discuss in a next session. But most of the things what I have discussed is helpful for you to answer these questions. Maybe not to the full extent because I have to discuss some other also, but I think at least 80%, 90% you can answer out of these discussions. Right, let's stop at this point, and I think now you have to start working hard because I think we are reaching the end of our sessions. Maybe in 2 weeks or 3 weeks time maximum we will be finishing, and you should get ready for your exams because exams are approaching, and I'm done with 80% of our discussion. So we are nearly there. I really recommend you look at these materials in detail. Plus, pass exam. So when is the exam? I'm not so sure, but I think it's yet to be scheduled. I'll let you know. Maybe I think it's after May. I'm not so sure. I can't commit. I cannot commit actually. I'm not so sure. I'll let you know next week. How can we get the 2021 paper? Is it? It's not available in your with the IBSL. Did you check with them? I think by now it should be available because I think maybe results will be releasing very soon. After that, I think the paper will be available. But you can check with the IBSL. I think it should be available very soon. Okay, can we stop here? Thank you and have a good weekend. We'll see you next week with a new discussion, new session. Okay, thank you.
Thank you, sir.